Private equity has experienced a big trend in popularity over the last 5 years. And here to talk with me about that is Mark Colgan from Montage Wealth Management. Mark, welcome.
Yeah, thanks, Bob. I appreciate you having me today. It's a great topic. I look forward to talking to you about it.
Yeah. So tell us more about why PE has experienced this sort of interest in popularity over the last 5 years or so.
It's a great question because it most definitely is a big trend. And I think there's a few things that have converged at the same time to really result in that big trend. One of the things that is really fascinating that actually Jamie Dimon, the CEO of JP Morgan, pointed out earlier this summer is that the number of publicly traded stocks has declined a lot. In fact, when you go back to like 1996, there was 7,300 publicly traded stocks. Today, it's around 4,300. So you're looking at about a 40% drop in the number of investments you can have available to you in the stock market. And that's big. So I think that is one big factor, is just the shrinking of what's available in the public side. There's definitely some other things, though. Like I said, it was a series of things that converged. Another one would be just the accessibility of private equity investments. It used to be even 10 years ago, getting into the private equity investment for what we call a retail investor was really difficult. You had to have, $10 million or something like that. Now the minimums are down to, maybe 100,000. I even have some that are down to 50,000. So, having the ability to invest smaller dollar amounts, I think, is key. There's also some other things. There was a lot of challenges with private equity up until recently that kind of, got people a little bit anxious, such as having their money tied up. Well, that's been addressed with some of these interval funds. The investors can have limited, but at least some access to their money on a quarterly basis.
In terms of, you mentioned a second ago that more and more people are eligible to invest in private equity. There was a time when maybe it was just accredited investors that you sort of suggested, or big institutional pension plans and whatnot that were investing in PE. But now it's becoming more democratized. One of the positives I've been told anyway is this notion that the returns may be greater than what you could expect or hope for in the public markets. Is that fair to say?
Yeah, it's definitely one of the things that attracts people, amongst others. In the 23-year period from 2000 rather to 2023, private equity investments had annualized about 11% a year during that same time. That was compared to the public stock markets averaging about 6.2. So there's, that's all just potential moving forward, but reflecting on what has happened historically, it definitely raises some eyebrows and interest.
So when you think about the characteristics of PE, what are some things that investors should know above and beyond what we've already described in terms of the good, the bad, the ugly?
Well, yeah, it's a great question because it's not for everybody, right? Just because it has better returns doesn't mean it's the end all. But continuing with the positives, I would say that the reduced amount of risk in these is produced as a result of lower correlation. Let's back up to 2020. We all know as investors that was a year of difficulty because both stocks and bonds declined at the same time. And while that's not completely an anomaly, it's very rare. And conservative investors really got shook up that year. And so those folks, as well as people managing pension funds and endowments, started scratching their head a little bit more frequently, saying, wait a minute, how else can we diversify our holdings so that we reduce risk? And so the lower correlation of private equity investing just became a little bit more popular. And so that's, another benefit that would be on the plus side for investing in private equity.
Oftentimes when people are told to invest, they talk about things being the higher the expected rate of return, the greater the risk. But you just seem to suggest that maybe PE equity may not be as risky as we might think?
So that's a really, really good question. I'm glad you asked. Yeah, in terms of volatility and correlation being lower, perhaps some benefit to it, seeing that you're getting better returns with lower volatility. But there is a but. There are other things to consider that may be posed as risk, such as the illiquidity risk, which simply means that investors are tying up their money for a longer period of time. These are not investments that you would want to put money in and hope to take it out a couple years later to see how things did. These are longer term commitments, and because you're tying up your money, that could be perceived as a risk in some people's eyes. And there's also other things that kind of work against them. There's higher fees, and there's higher concentration of your investments in fewer companies. So you're really relying on managers. We call that manager risk, to make sure that you get a good result. So all of those things together should be most definitely considered as part of the risk formula.
When I think about private equity, I think about how private equity is now involved in so many different types of industries, dental practices, landscape practices, the list goes on and on. Talk more about sort of like the stages of private equity that you see, and which is the most dominant stage where this is you're seeing growth.
Yes, that's a good point, because with traditional retail investments, a lot of people are simply saying small cap, mid cap, large cap. Along that theme, but in some ways much differently, when you're investing in private equity, they're traditionally pretty small companies if they're in stage one. Now, so let me back up. There's three stages. Stage one is the venture stage. Stage two is what they call the growth equity stage. And then the stage three is the buyout phase. And it's important to understand the characteristics of each of these phases, because it provides a different experience for the investor. If a private equity fund that you're putting your money into is concentrated in the buyout phase, it's going to feel a lot different than if you have a private equity investment concentrated in the venture phase, or venture stage, I should say. But back to your point, to define that, it's, stage one is typically companies they're startups. Their cash flow is kind of unpredictable. They may or may not make it. There's maybe a 10 to 20% success rate of companies that are going to excel, and maybe 80 to 90% of those in stage one may go bankrupt. When you get into stage two, the growth equity phase, you've got companies that have a little bit better infrastructure. Their management is more experienced. They're beginning to show promise with their cash flow, a little bit more consistency in profits. And then finally, stage three, in the buyout, you've got really well-established companies. They've got a good track record. They might have been around for 10 or 20 years, strong management, consistent revenue, maybe even reoccurring revenue with positive cash flow on a regular basis. And those companies look and feel a lot more like the established companies you see on the stock exchange.
I mean, given the unique nature of PE, it sounds like investors would need the help of a financial advisor to sort through which stage they're investing in, and what the risk return profile is, and how it fits into their portfolio in terms of correlation, in terms of illiquidity premiums, et cetera, et cetera. This is not a simple buy and hold an index fund strategy.
Yeah, you're right. It's definitely more sophisticated. I suspect one could dedicate a considerable amount of their time to educating themselves. But my fear with that would be that the information I see on the internet sometimes is right, sometimes is not. I even had an AI prompt tell me something that was just totally wrong. So I would rather someone rely on either a financial advisor or an expert in the area that has extensive knowledge of the inner workings of private equity, and how it should fit into their existing portfolio, and how it may or may not, be aligned with their goals, right? I mean, these are long-term investments. So if you're looking to buy a home with an investment in 3 years, you shouldn't even be in private equity at all.
And if you're, say, in the retirement decumulation phase, with hope you're not putting all your eggs in one basket, because ultimately, if it's in an IRA or a ERISA type account, you might have to take RMDs, and that could be potentially problematic.
Yeah, well, for sure, yes, it's a good point. I mean, if you're in an investment that you just have mandates to take money out, and yet the investment doesn't allow for it, it's a bad match. So typically, we would consider it more appropriate for someone who's in their 30s or 40s for their retirement accounts, or for someone who simply has the ability to leave it in a non-qualified, or what we call an after-tax account, as just perhaps money that they know they're not going to touch for, let's say, 10 years.
So some of our viewers may be familiar with a recent announcement from the National Football League saying that they will now allow private equity investors to own up to 10% of a team. Tell us what you know about that.
I really found that fascinating. Back in 2020, the Major Soccer League had opened up the door for private equity, and it was similar headlines that we saw. And if we look back on how that has impacted the major soccer leagues, one could probably conclude that it really increased the popularity of soccer, especially in the United States. And then it gave them bigger budgets. So you've got some of the famous stories of leagues that had big turnarounds and comebacks because they had the funding to either rebuild the stadium or recruit better players. So if some of those themes carry into the NFL, then it's hard to believe that the NFL would become even more popular. But I would say that perhaps on an international level, the NFL would become more popular overseas. And you know what? The players have a pretty big salary, but some of those caps might be bumped, and perhaps they get paid even more.
It's interesting that a league that already owns Sunday, Thursday, and Monday night could now own the world, perhaps, as we think about what could happen. We're talking on the very same day when the Green Bay Packers will be playing in Brazil. And so we are now watching, I think, the advent of the NFL becoming truly an international sport. I don't know what the future holds in terms of that. But it's interesting, as you said, to have PE firms involved in this. One last question, Mark. When I think about PE firms, I think about their motive in buying a company, regardless of what stage, is to generate a return on investment. Does that sometimes come at the expense of the customer of the company, the dental practice, the landscape company? Are there conflicting forces that what might be good for the investor may not be great for the customer?
In my experience, that hasn't been the case. There's this phrase in the industry called value creation, and it talks about how startup companies years ago used to be privately held, and they, probably 5 to 8 years later, they would go public. Now, what we're seeing is that's being stretched out. A lot of companies now are being retained by private equity firms for maybe 8 to 11 years. And it's during that 8 to 11 year time frame where there's a ton of value created within the organization, providing, and a lot of that's because the private equities are just infusing so much cash and reinvestment into the company. You're seeing these companies excel with better products from more research and development and being more competitive and innovative. And then after perhaps, let's say, year 11, they finally go public, and they tend to be better established. So that's some of the trends and some of the whispers we're hearing about the impact of private equity being more positive. I'm sure there's got to be stories out there too that might suggest otherwise for one reason or another, perhaps. But I generally see some good things.
Well, we've covered a lot of ground. Anything we missed or bears reemphasizing?
The one thing I would probably add is just the definition of an accredited investor. There's different layers, right, of these definitions, but the SEC says that these investments can only be purchased by an accredited investor, which is somebody that has income of over $200,000 or they work in the financial services industry, or they have a net worth of at least $1 million. There's a couple other nuances to that definition that has expanded the opportunity for more people to be qualified as an accredited investor to be able to buy these private equity investments. And then there's other levels, if you will, like one of the higher levels is called a qualified purchaser, and those folks have to have a net worth of $5 million. And each of these levels, there's different product offerings available. So it definitely means that you've got to be the right investor, qualified by the SEC, and it just once again underscores the importance of working with an advisor who understands all the nuances of this complex investment area.
Well, Mark, I so greatly appreciate you sharing your knowledge and wisdom with us, and I look forward to talking with you more about other topics in the future. So thank you.
Okay, Bob, sounds good. Thank you.